Good morning, students. So we are in the last leg of this topic of PGBP. I'm sure by now the manner in which we have proceeded, the level to which we have reached, this would have definitely given you a lot of clarity, lot of confidence, and also a sense of expertise over these topics, the various provisions under the PGBP head. So with this, we will now proceed to complete the PGBP head by covering the specific sections which we have kept aside for discussion at a later stage that we are going to deal with. We have been solving practical sums. We have been revising the provisions, but still, if you have doubt in any of the provisions, any of the practicals that we did, I'll first take up your queries and then I will proceed with the remaining sections so that we complete this whole topic today. Yes, very good morning to everyone. Very good morning, Mehak, Anshul, Sridhar, Isha, Kambira, and everybody present over here. Welcome to this session where we are going to deal with some specific sections of PGBP head. So first, over to y'all. Anybody, any questions, any queries, please put it across. Yes, students, I'm waiting for your queries. No queries? All through? Everybody? Then should I proceed? Yes. Now see, from our notes, we have discussed till this point where I explained you the provisions of the debit side, credit side, and the debit side provisions were divided into two categories. One, these golden rules with their exceptions, and two, the restrictive provisions, which we have also seen in various questions. Now we come to some specific sections. Firstly, some specific deductions. In this section 35 AD we did in the previous class itself, but as a revision, I'll just cover it again. So what is 35 AD? So 35 AD is a specific deduction which is allowed only to some specified businesses. We call those businesses as businesses specified under 35 AD. So there is a list of these businesses. What is important? This deduction is allowed in the old scheme. It is not available under the new scheme, which is now the default scheme. So it is not available in the new scheme. So in order to avail this deduction, you have to be in the old scheme. So see, till now we know three sections, rather two, third one we are going to deal with after this, where the deduction is not allowed in the new scheme. One, scientific research payment to outsiders. Two, 35 AD. Correct? Now, what are these 35 AD businesses? So they have listed out some specified businesses. So first is you are running cold chain facilities for some specified products. Second, you are running warehouse for storing agricultural products. Next, cross-country natural gas or crude petroleum pipeline. Now today this is a buzz because of this hormones problem. Now we are trying to set up a dedicated cross-country pipeline for transport of crude oil and natural gas. Next, you are running hotel which is of 2-star or above category, or you are running hospitals which is of 100 beds plus capacity, or you are into some housing project which is one either for slum redevelopment or under the notified schemes of the central government. Next, you are into production of fertilizers. Next, you are running inland container depot or container freight stations. These are the locations for storing goods before their import or export. Next, you are in the business of honey bee keeping, whereby your products are honey or beeswax. And last, you are into warehousing of sugar. Plus, there are two or three more. So, these are the specified businesses for which Section 35 AD provides a special deduction. What is this special deduction? Our general rule is we can claim deduction only of revenue expenses. However, if you are into any of these specified businesses, you can claim the complete capital expenditure in the first year itself. Now, when you can claim the capital expenditure entirely, that is whatever is your cost on building, plant, machinery, the entire amount can be debited to P&L. Which P&L? PGBP P&L. Then logically, you cannot claim again depreciation because you have already taken the deduction of entire capital asset value. So now there is no question of again taking depreciation. Now, out of all capital expenses, what is not eligible for this deduction is expenses on land, goodwill, or your financial instruments like you have invested in shares, debentures, bonds, mutual funds. So these are not eligible. Other than that, building, plant machinery, furniture, motor car, all these are eligible. Further, even the capital expenditure incurred prior to commencement of business, that is preliminary, are also eligible. Now, a condition, your business should not be started by splitting up of existing business. It means it should be a new business. It should not be just makeover of old business into new, or because of demerger, two separate companies are created, but the business is old. It will not be eligible. Similarly, for this benefit, your plant and machinery should also be new. Imported is allowed to be second hand, or up to 20% second hand plant and machinery is allowed. Remaining should be new. Now, most important point, wherever you are making payment for this capital asset, and definitely it will exceed 10,000, it should comply with the requirements of 48.3. That is, the payment should be only by way of account, pay, check or draft, or through specified mediums. Next, if the asset is sold, that is demolished, discarded, transferred, then whatever is the amount you receive, that entire amount is treated as your PGBP income under Section 28. If you remember, we had studied the entire Section 28 list in the first lecture itself, and 2 points we have kept aside. One is this. So, what is this point? Wherever you have sold this asset, the asset on which you have claimed 100% deduction under 35 AD. So, whenever you will sell it, the sale proceeds that you will realize, that entire amount will be treated as your PGBP income under Section 28. Another restriction is if you are not selling the asset, but within 8 years, that is right from purchase, within 8 years, if you start using the asset for a business other than specified business, then there is a problem. So, in short, the condition is that the asset which you have purchased, on which you have taken 100% deduction in year one, that should be used only for this specified business and not any other business. But if you start using it for any other business, then what will happen? We will take your original cost, which is the amount allowed as deduction. So this is nothing but the cost of the asset minus the notional depreciation. What is notional? So you have used this asset for 4.5 years. So we will take this 4.5 years period, find out what could have been the depreciation in this period. Now, why we are saying what could have been the depreciation? Because since the entire cost is taken as deduction in year one, obviously you have not taken actual depreciation. So we are taking a notional depreciation. And the difference between these two is treated as PGBP income of Section 35AD business. So for this business, the amount, that is, you can say the notional WDV of the asset on the date on which you start using this asset for other businesses. So the moment you transfer this asset from your 35AD business to any other business which is not in 35AD, that year, the difference between cost and notional depreciation, or in other words, the notional WDV, will be treated as your 35AD business income. Correct? Then you cannot claim deduction for the same asset under other provisions. So if you have claimed under 35AD, you cannot parallelly claim under 10AA or Chapter 6A, though these sections may cover the same benefits, but you logically cannot claim the same benefit twice. Second, this condition is specifically in relation to the hotel business. So in relation to the hotel business, the important point is what happens many times, the person who is running the hotel may have himself not purchased or created, that is constructed the hotel. Generally, the hotels are uh, purchased by somebody else, but that is constructed on created by somebody else, but it is managed by some other group. Now, in such cases, the question is who will be eligible for this 35 deduction. So since it is an investment linked deduction, that is, it is based on doing this capital expenditure. So we will allow this deduction to the person who has purchased and created the hotel. Maybe the person himself may not be running the hotel, but this is a unique feature of the hotel business. So here we will be treating the owner of the hotel as the person eligible for 35AD deduction because that person has done the expenditure. And last important point, wherever there is any loss from this 35AD business, there is a restriction that it can be set off only against income of other eligible business. In other words, 35AD loss can be set off only against 35AD income. Second important point, if this loss could not be set off, why? Because you are not having any other 35AD where there is income, then you can carry forward it as per 73A. What is important? It can be carried forward for any number of years. So there is no time limit. For other businesses, the losses can be carried forward maximum up to 8 years. Here, there is no such time limit. It can be carried off for any number of years. But again, in future, it has to be set off only against the 35AD business. Is this clear, students? So this is all about 35AD, the section which we had discussed in the previous lecture in detail. I've just summarized it in brief. Any questions? Nisha is asking, sir, Jan 27 के लिए कौन सा celeb use होगा? See, simple logic, I'll tell you, everyone. Whenever is your exam, treat that year as your assessment year. Means what? So your exam is in June 27, is in September 27, is in, sorry, 26, or is in Jan 27. So any of these exams, when they are falling in the financial year 26-27, so treat that financial year as assessment year. Correct? So whichever exam you are going to appear for, see the year in which that exam is falling. That year is your assessment year. So the earlier year becomes a previous year. So in Jan 27, if you are giving exam, your previous year will be 25-26, and what we are studying now, the same syllabus will be applicable to you. Fine, beta? Anshul is saying, sir, please explain point 10. See, point 10, Anshul, is now in case of hotel business, let us say I have invested by creating that entire hotel building and setup. So I spent 100 crores in creating that entire hotel or resort, which is eligible for 3580 business. But I have no knowledge of running the hotel. So I contact the Oberoi group. I contact the Taj group who are into hotel business for years. I say that I have invested money of 100 crores. I have created this whole structure, this beautiful hotel, and now you run and manage the hotel. So actually the hotel is run and managed by Taj Group or the Oberoi Group. Now in such cases, their balance sheet is showing the actual hotel revenue income. What I may be getting is something like a rental or sharing in the hotel revenue. Now the question is, out of both of us, who will get 3580 business deduction? So logical answer is it will be me only, for the simple reason that I have invested that 100 crore rupees. My balance sheet is showing the assets like the hotel building, all the infrastructure in the hotel. So that is what is clarified. It is the person who have invested in the capital expenditure will be eligible. Sridhar is asking, sir, amortization and preliminary expenses is written off over 5 years or 10 years. But the answer is in the Income Tax Act, in PGBP head, only if you are into mining business. Only for mining business, the period given is 10 years. For all other preliminary, like your general preliminary under 35D or your preliminary expenses in the form of amalgamation demerger expenses or the amortization of BRS expenses under 35 DDA. All these three sections where amortization of expenses is given, it is always 5 years. Similarly, for family planning capital expenditure amortization, it is also 5 years. So it is not 10 years. 10 years is only for mining business, and our syllabus at inter level is not covering that section. They have kept it for final level. But just when I was explaining you, I thought you should be kept informed. It should not happen that at final level, suddenly when you study that, you have some doubts or confusion, right? Good. Yes, students. What are your doubts? Because now I'm going to start a new part, which is depreciation. This is the second most important part in PGVP besides your practical that reconciliation. This is the second topic on which you can expect a separate practical sum. So now next 1 hour we'll be dealing with this section 32, and then in the balance time we'll deal with the remaining small theoretical sections. So before that, anybody, any questions? Okay, so it seems you all are thorough with all the provisions till this point. So now let me go to depreciation. Now see, depreciation is something which is not new to us. We are the students of accountancy of commerce. So in our accounts, right from your 11th to 12th standard stage, you have been studying depreciation. In fact, over there you had a separate dedicated chapter where in detail you studied the depreciation calculation, the SLM, WDV, everything in depreciation. Now, under Income Tax Act, we have a dedicated section 32 and a dedicated rule 5. So section rule. Now we have to understand income tax depreciation as to how income tax allows depreciation. Now in this, I have first taken a comparison between income tax and accounting depreciation so that you can understand comparatively where they are different and what pointers are same. Now, all these 4 pointers have some important differences. When you read it for the first time, it may not match your thought process. You may feel, no, it is not correct, it is wrong. But please understand and appreciate. I have been telling this in past 2 sessions also. Every subject has its own method. So you have now studied one method or I'll say one approach which is as per accounts. Now, today you are going to study another approach which is as per income tax. Even if it does not matches with accounts, that does not mean that it is wrong. So why I'm telling you this? Because many times when we study income tax depreciation, since the provisions given over here, since the method of calculating depreciation given over here is very different from accounts, we suddenly feel discomfort. We are not saying accounts, what you have studied is wrong, or what we are going to study here is the right approach. No. Two laws, two subjects, two approaches. Like I'll put it other way. Even in accounts, you had SLM, WDV. Both were having different ways of computing depreciation. Both were giving very different answers. But you never challenged, ki, okay, this is right, this is wrong, or this approach only should be followed. No. Similarly, income tax has its own approach, which is very different from the accounting approach. Income tax. I think there was some technical issue. Okay. So I was saying, in accounts, you compute depreciation for each asset separately. What does income tax do? They say, don't spend time in calculating depreciation for one asset. Instead, you make a group of the assets. Group means what? Now, let us say you have 100 assets. Now, what accounts will do? It will do calculation of 100 assets separately. Income tax says no. Club them. Now, clubbing them on what basis? Same asset, same depreciation rate will be put together and will be treated as one block. So you can understand one block as one group. So let us say you have buildings. One is your factory building, one is your administration building, one is your go down. Then you start another plant in some other city. Now, when you have multiple buildings, now all are same asset because all are buildings and all have same depreciation rate of 10%. Then income tax says why to compute the depreciation of each building separately? Let us group them and make them as one group so that we will calculate depreciation for entire buildings group comprising of, let us say there are 12 buildings as on date. So everything will be calculated as one. Importantly, if any building out of this 12 is sold, the value is deducted from this. If any new building is purchased, the value is added in this. I'll show you the format. Similarly, you have different types of machineries. Now, within plant and machinery, since different machines have different rates, they have created different blocks. So the machines having 15% is in one block, the machines having 40% is in another block. Now, within this block of 15%, you have 25 machines. Within this block of 40%, you have 6 machines. Correct? So what again you have done? You have grouped them, and each of these groups is called as a block. Then you have motor car. Now you may be having different types of motor cars purchased at different points of time. Some may be normal motor cars, some may be trucks, some may be trailers. Everything put in one block, one group. So let us say you have 25 motor cars, all put in one group. So first difference in accounts and income tax depreciation is accounts would have computed depreciation for each asset separately, how we have studied. Income tax says don't waste time. Group them and make blocks. Blocks means group of assets. Now, when you make blocks, in your books, you are having 100 separate accounts. Here, blocks, you may have 6, 7, 8, because each block will be having, some may be having 12 assets, some may be having 25 assets, some may be having 6 assets, some may be having 14 assets. So, total, you have only 6 blocks. But in number of assets, you have 100 assets. So, this is the first difference. Now, comes the second very important difference, which will affect our calculations. This second difference is, now recall your account depreciation. When you purchase an asset, in the year of purchase, you were taught to pay attention to the date. So let us say some asset is purchased on 15th of July. In that year, what you will do, you will calculate depreciation not for the whole year. You will calculate depreciation from 15 July to 31st March. You will count the number of months or days, and you will calculate the depreciation of the first year proportionately. Proportionately means in proportion to days or months. I hope this is clear. You all remember this. However, again, what income tax says, why to go into so minute calculation of days and months? Instead, simple. In the year when the asset is first put to use. So first difference is we are not going by the purchase date, which accounts does, we are going by the put to use date. So the year in which asset is put to use. So if the asset is purchased and put to use in the same year, so in the first year itself, if it was purchased and put to use, which will happen in majority cases, you will be allowed either full or half depreciation. So no doing day wise or month wise proportion. Simple. In the year of purchase, if the asset is put to use in the same year, you will either take full depreciation. Let us say the asset depreciation rate is 15. So you'll take full 15%, or you will take half, that is 7.5%. Now you'll say, sir, how I'll decide whether I have to take full or half? So for this, the rule is, if in the year of purchase, if the asset is put to use for less than 180 days, you will take half depreciation. So what is the condition or when you have to take half depreciation? If in the year of purchase, the asset is put to use and it is put to use for less than 180 days. Now, interestingly, you will say, so, sir, we'll have to count every time. Answer is no. I'm giving you the cutoff date and it is easy to remember. 2nd October is one of our special days, especially for we Indians, because it is the birth anniversary of our Mahatma Gandhi. So everybody knows the 2nd October. Now, if you count from 31st March backward, you get this as the cutoff date in normal cases. And if it is a leap year, it will come on 3rd October. Now see, we will be getting some generally of 25, 26 only, which is our relevant previous year. And this year is not a leap year. So for us, the cutoff date is 2nd October. Now, what you have to see? You have to see the put to use date given in the question. If the put to use date is after 2nd October, simply you should know you will be taking half depreciation. If the cutoff date is 2nd October or earlier date, you will take full depreciation. This is the simple point you have to keep in mind. And if you count from this 2nd October onwards up to 31st of March, you will get exact number of days as 180. So this is what is our cutoff point. I hope this is clear to all. Now, similar to purchase, again in accounts, what happens? In the year when you sell the asset, again you are selling the asset somewhere in between. So remember your accounts depreciation questions. You have sold the asset on 10th of December. So what you again do, from 1st of April to 10th of December, you'll again calculate depreciation, not for the full year, but for this proportionate period or part of the year period, which is starting from 1st April to this date of sale. Income tax says we do not calculate any depreciation in the year of sale. See, this is where when we study income tax depreciation, it does not connect much. Why? Because we have been habituated for past 4 or 5 years and we have solved multiple 30, 40, 100 sums on depreciation only as practiced during your 12th standard for preparing for your exam, that now you are thorough with that and you are very comfortably used to taking depreciation precisely day wise or month wise. In fact, those were the main adjustments at that time, that whether you calculate the depreciation correctly, proportionately or not. Even today in accounts, when you get anything on depreciation, you have to calculate it maybe in partnership, admission, retirement sums. You always keep in mind this proportionate point and you always do it proportionately, right? Income tax is sorry. For purchase also, we will do it either full half. For sale, no depreciation at all. Now, somebody will say, sir, what is the logic of this? Okay, you have already given us a inclination or intimation that okay, income tax is different. But still, when income tax has made some different law, it should have some logic. Yes, I'll tell you what is the income tax logic. Why they are not being so precise. First, they are not doing asset wise, they are grouping the assets. Second, for purchase and sale, they are not being precise with the date. So you don't find comfort because see, we are very used to doing very precise calculation. And when it comes to calculating depreciation, calculating interest, we have been taught that it has to be date specific. So now you are not finding it comfortable. Now let me tell you something about depreciation. You all will agree that depreciation itself is a concept which is never precise and perfect. What I mean by this? Let us say I have purchased a motor car. I'm using it for past 2.5 years. Now today, if I calculate depreciation even precisely as per your accounts, so what I will do, I will take the cost of the vehicle, let us say 15 lakhs, minus what is precisely the period of use. I'll find out the depreciation of that 2.5 years. I'll deduct it. So today, let us say I get the value as 9 lakhs. After that, 2.5 years deduction. Now, I'm sure you'll agree to this point that nobody will assure me that, okay, sir, this 9 lakhs is the perfect value. I'm sure you will accept this point that the amount we calculate of depreciation and on that basis of the WDV, both are estimated amounts, not the precise or perfect amounts. I'm sure you'll agree to this, right? Means what? The entire concept of depreciation itself is something which is not going for precision because it is only an estimate. That is why now we specifically use this, and I'm sure you would have realized this, especially when you have come to professional level, that we do not write to depreciation in our P&L or anywhere. We write to provision for depreciation. If you have not noted this, please note this point. We do not write depreciation. We write provision for depreciation because it is an estimate. It is a provision. It is not exact amount of depreciation. I'm sure you are understanding what I'm trying to explain. Now, when even accounts or every subject agrees that depreciation is only an estimate, and after deducting this depreciation, whatever WDB or whatever value you are showing in your books is not the precise value. It is again an estimated value. Okay, that after 2.5 years, this asset is of 9 lakhs. When you agree to this, then why you are being so rigid with the date or with the calculation? Because anyways, your precise calculation is also not giving me the final precise value. It is still a roundabout value. It is still just okay. We need some value WD, so we have calculated, but that he also agrees not perfect and precise. Agreed to this? And that is why you have different accounting standards. One is for depreciation, and then you have a separate accounting standard which deals with impairment of assets. Why was that different accounting standard required? I'm sure you would have by now studied this, right? You know impairment of asset accounting standards, or maybe very soon you'll be studying it. So why we have that another accounting standard again dealing with valuation of assets for the same reason, right? So income tax says, let us not be very rigid with the working. Let us do a different way of working where we will also get some amount. Again, may not be the precise amount, but since it is anyways going to be an estimated amount, a provision amount, so we are okay with not being so precise. That is why income tax has modified their workings accordingly. Now coming to the last point of the difference. In accounts, whenever you sell as asset, you calculate the profit or loss of each asset sold. So today, if you have sold one building, you'll independently find out what is the profit or loss of that. Income tax says no. Firstly, in income tax, I'm sure by now you'll understand that this profit and loss will be treated under a separate head, which is capital gain. First point. Second point, what income tax says is now we have created groups or blocks. So this is of building, this is of plant and machinery 15%. This is of motor car, which is again 15%. 15% is the rate given, right? This is of plant and machinery 40%. So we have different blocks. We will find out the capital gain or loss for entire block and not for one single asset. So you may have sold one single asset. Now let us say you have sold building. Now accounts would have gone to find out the independent value of that building and the profit or loss on that building. Income tax will not do that. Income tax will say we will wait for my entire block to cease to exist or to become nil. That is, we will not calculate profit and loss for each asset sold. We will calculate profit and loss for the entire block. Obviously, that profit loss will be a capital profit loss. First point. And second point, when we will do it only in that year in which my entire block ceases to exist. That is, all assets in the block are sold, or the WDV of the block becomes nil. So in short, the difference given over here is we will not go to compute profit or loss on sale of independent asset. We will do it only once where the entire block is gone, right? Now, whatever I have explained here, that we will understand with a practical point. That is, we will go to the format, and then I have created a practical question, which I am calling it as conceptual question. In this, I have taken different situations. Now, we will solve this so that whatever this I have explained, you'll understand that. And once that is done, we will proceed with the theoretical part. I hope this is clear. Anybody, any questions at this point, please ask me so that I can first clear your doubts and then we'll proceed to deal with the actual calculation of depreciation. Yes, students, your doubts, please. No doubts? I thought you would be having doubts. Okay. Santosh is saying, how would I remember such a big provision? See, beta, any provision, big or small, you can remember one way is by regularly being in touch. See, first thing, don't expect that on day one you'll understand and remember everything. In fact, for remembering, you have to do repetition 4 times, 5 times, 10 times. That depends upon everybody's remembrance capacity and which is different. And nothing is right and nothing is wrong in that. Somebody may remember things in 1 or 2 go. Person like me may require 4 or 5 repetitions. Somebody may require 8, 10 repetitions, and everyone is okay, right? So for remembering provisions, one is repetition. Two, when provisions are very big, very complicated, the second most important thing that is required is a proper way of understanding, reading it. That proper way we provide you in the class. Like I have given you my short notes curated in a different fashion than how the act or the module is created. So all these things will help, correct? But for that, you need to do repetition. So that is the key point that I have been telling this right from day one, that whatever I'm teaching, please keep revising. Now, you are solving this topic. Today, this topic will be over. Next class, another topic will start, but you have to make it a point every week once, maybe on your weekends, you can solve it. And let me tell you the best part. Now, as you will proceed further, you will prepare. When you'll go to articleship, you will get the practical exposure of this, because these things are what you will see in your articleship. Immediately after you clear the center, you will start your articleship, and when you will see the actual return filings, the actual income tax computation, these things will again get revised, because over there you are going to do this again and again. Fine, students? Okay. Anshal is asking, sir, if a person use less than 1 month. See, Anshal, I have already mentioned one thing. If it is a new asset, that is which you have just purchased, and if you put to use for less than 180 days, now less than 180 days can even be 1 day, not even a month, 1 day, you take half depreciation, correct? So answering your question, that if a person uses it for less than 1 month, I'm saying not even 1 month. Let us say the question says this asset is purchased on 31st of March and put to use on 31st of March. So you have used it only for 1 day, half depreciation. Simple. Aditya, sir, how to calculate PGP difficult problems? See, Aditya, in fact, in our previous class, if you remember, I have discussed various questions from the module which are given at the back. In fact, before me discussing that, in the class previous to that class, you were given it as a homework. You all had solved it. You all may have understood it 40%, 50%, 60%. But after my solving in the previous class, and since we did revision of some more sections, you would have found more clarity about those sums. Now, in the same fashion, when you keep repeating it, now how to repeat it first? After today's class, you will complete the entire module again. So this weekend's target should be revising, reading the entire module once again. Point number one. Point number two, once you have done that, the next step you will have is that then you will go to solving the past exam questions which are all published on our website. You go to our BOS portal. There is a separate section for past exam questions, for MTPs, RTPs. So these are the different materials which are put. You take the material, you open them, you select the question on PGBP and then practice it from there. Again, what will happen? Maybe that question you will find very simple, because exams have both type of questions. Maybe it is okay, manageable by you, or it may be, as you are saying, very difficult. Now, very difficult category sums would be only 10, 15, 20% out of. So out of 10, you will find only 1 or 2 sums very difficult. Remaining would be either very easy or manageable by you. For those 1 or 2 sums which are very difficult, what will be difficult in that, Aditya? 1 or 2 adjustments. See, try to recall your trial balance to balance sheet sums. When you solved it for the first time, you found many adjustments, discomfort. Then as you kept on solving two, three more, those adjustments were now very much clear to you. You were able to solve it correctly and with pace. Then few more adjustments came up. Again, those were new, they were different. Some you understood, some you had challenge. But how you reach to a level? By practicing more and more questions in balance sheet sums. Same thing we do here. The more questions you solve, the more your range of solving difficult sums increase, more those difficult sums will become manageable for you. And that is how you reach to a level where you will be able to solve any type of question. Fine, Aditya? Gerald James is asking, sir, what if amount of depreciation as per IT is higher? So, beta, we have already done that in our first three classes. What we have understood right from class 1. In my very first class, we first did a practical question to give you a feel of this whole chapter, where I also explained you the format of solving PGBP, which was reconciliation. And in reconciliation, what we have understood, there is one figure in accounts, there is one figure in income tax PGBP. We have to adjust the difference. Correct, James? Now, what will happen? For depreciation, simply what you have to do, whatever is the entire accounting depreciation, you put it in the add, and whatever is the IT depreciation, income tax depreciation, you put it in the less. Automatically, what will happen? If your IT depreciation is higher, as you are saying, so automatically the extra amount, which is the higher amount in IT, will get subtracted. This is what is the effect. Because now think about this logically, that if income tax is allowing you higher depreciation, so mathematically the income tax, that is a PGBP income, should be lesser as compared to accounting net profit. And exactly that is what will be happening. You will be subtracting a higher amount, so the final PGBP income that you will get will be lesser than your accounting net profit as far as this depreciation difference is concerned. Correct, James? So that is why we, in fact, before I came to all these sections, if you remember, very first class, we started with practical. Because when you have that practical frame in your mind that, okay, ultimately what we are studying, what is the final impact, we are going to adjust the difference. Then understanding these sections becomes even more logical, right? Okay, Aditya has raised the hand. Yes, Aditya.
Good morning, sir.
Very good morning, beta. Tell me.
Sir, in which year should I start PYQs of PGB, sir?
Sorry. I did not get you. Can you please repeat?
Sir, in what year should I start PYQs? Some tax rates are changes nowadays.
See, beta,
January.
understand one thing. Understand one thing. When you solve past exam questions, maybe of 1 year, 2 years old, what you are saying, what has changed? Tax rate, correct?
Yes, sir.
Has the PGBP changed?
PGB,
Has
no, sir.
the,
No.
then simple, na? We are not yet going to the calculation of tax. Now, you want to practice calculation of PGBP income. You want to practice the difficult level of sums of PGBP. So you restrict yourself up to PGBP. Now, why you are going to tax computation? See, tax computation is the last part, correct?
Yes, sir. Yes, sir.
You first solve the entire question by finding out salary head income, house property head income, business head income, etc. And then by totaling all the income, finally at the end, you will find tax is the last part that you do in a practical sum. Don't do that, na? Let there be a change in tax rate. Clear? Second.
Yes, sir.
Now pay attention. Second point. There is a possibility that in past 1 or 2 years, there could be one of the points which has changed in PGBP, because obviously the head also may have an amendment, though there is no major amendment in the heads, but 1 or 2 here and there are amendments. Now, even if you have studied today's latest amendment and that sum is solved by some past amendment, your and the answer that you are going to check with, which is given in the past exam question, etc., would be different by that one adjustment. But then when you will check your answer, each reconciliation amount you are doing will be matching with them, but one adjustment did not match. Why? because you are referring to some past exam question where the answer is as per the past year, but you have solved it by the current year. So for that difference, either by reading the provision, you will realize yourself, or you keep it marked, get it clear from us. Na?
Yes, sir. Yes, sir.
So don't worry, Aditya. And third point, now let me tell you the most important point. When I'm saying refer whatever is hosted, you need not go for 4 or 5 years back. Just take whatever is hosted of last 1 year. Now, in last 1 year, we have hosted all exam questions. We have hosted all exams MTPs or exams RTPs. In last 1 year itself, you have three different material sets.
Yes,
When I'm
sir.
saying set means what? In past exam, you may have three attempts questions. In past MTP RTPs, you again have three attempts MTPs RTPs. So this itself is a question bank of 20 sums of only 1 year back. Are you getting this?
I'm getting, sir. In
So don't
MTPs,
worry. There won't be much problem with this amendment part. That is in short nutshell, right?
okay,
Clear?
sir. Okay. Clear, sir.
Okay, students. Now, what I have explained till now, that we have to do calculation blockwise. So now the format of calculating depreciation is, this is, you can say, this will be called as your particulars. And then you will do calculation of each block in this format. So let us say I'm doing the calculation of block of plant and machinery 15%. Now same format will be applicable for building block, for plant and machinery 40% block, for motor car block, for intangible assets block, for everything, the calculation will be this. Now first what you have to do is you have to take the opening WDV as at the start of the year. Now let us say it is 25 lakhs. And it includes how many assets? As I've said, let us say this block has 25 assets. So keep in mind, okay, then I'll change this value. Let us say it is 35 lakhs. And how many assets are there in this block? There are 25 machines. So this 35 lakhs is the total of 25 machines WDV, correct? So you start with opening WDV, which is of all the machines in that block combined. Now, during the year, I have purchased 4 machines at different points of time. One I have purchased in April itself, another I have purchased somewhere in August, another one I have purchased in December, and another one is purchased in March. Let us say. Again, what we have to do, even though you have purchased at different points of time, you will add the total value of that. Let us say the total of all the 4 machines is 20. You will add the total of opening plus new machines is 55. And now how many machines it has become? 29. Now, during the year, out of these old machines, now opening means old machines, few machines have been sold, demolished, discarded, right? So out of that, 3 machines are sold. Again, at different points of time and at different values. You will combine them. Let us say the combined value of these 3 machines comes to rupees 12 lakhs. You have to subtract it. So what is the position of this block at the last day of the year? The position is you have WDV, which is 43 lakhs, and you have number of assets, which is now 26. So we have to find out the position of the block on the last day. This what we have computed. This is called as WDV under 43.6. And this is the whole working which is given as per rule 5. So you have to find out the position of the block as on the last day. So on the last day, this block has 26 number of machines and the total combined value is 43 lakhs. Now, for this 43 lakhs, you will compute. Sorry. For this 43 lakhs, you will compute depreciation. Now comes the calculation part. Now, within depreciation, there are two depreciations, normal or regular, and there is one special depreciation called as additional. Before I tell you the difference, let me first, so you for the time being keep additional depreciation aside. So normal depreciation, now you have to compute this depreciation in two parts, as you can see, half and full. Why half? Because there is a possibility that out of these four assets which are purchased during the year, few assets, one or two or three, may have been put to use for less than 180 days. For those assets which are put to use for less than 180 days, out of these four assets which were purchased, you will claim half depreciation. And for the remaining assets which are more than 180 days or which are in the opening, you will calculate full depreciation. So you will calculate the depreciation in two parts. On few machines half and all the remaining machines full. Correct? And this amount of depreciation is the amount which is the final amount of depreciation as per IT provisions. Normally, in all practical sums, this amount is given as one of the adjustments. Now we have solved multiple sums, so you can understand this. In the adjustments, you are given one point which says depreciation as per IT provisions, which is this amount. So in your comprehensive sum where you have to compute entire PGBP income, this amount generally is given as an adjustment. Out of 20 sums, comprehensive, one of the sum will require you to compute this amount. If you remember in our previous class also, some question number 6 or 7 which we solved, it had this calculation. So we did it on the side I have showed you the calculation. What I did exactly the same thing. I took opening, I added purchase, I subtracted sale, and on balance I simply computed the depreciation. If you remember that sum of the previous class. So out of 20, one of the sums will require computation of depreciation. This is, I'm talking about that comprehensive sum, which is generally asked in the exam as a compulsory question, right? So for that sum, the depreciation amount, which if you have to calculate, is this. But out of 2019 sums, this amount they have calculated and given you directly as an adjustment, which if you remember in every sum that we solved, the amount was given separately in adjustment. We had to simply use it in reconciliation. Now, in your entire paper, like one comprehensive sum where you have to compute entire PGEP income, you will have other sums where you have to solve only some part of the working. Like if I talk about PGBP, you may have a sum separately of 5-6 marks, which will be only on computing depreciation, which will be only on scientific research, which will be only on preliminary, right? Now, when you get this type of question, which is only on depreciation, then this particular working becomes the main answer, right? Is this clear, students? Now, coming to this regular depreciation and additional. Now, when you study the Income Tax Act sections, section 32, which deals with depreciation, has multiple subparts. First is section 32, subsection 1, clause 1. This deals with depreciation of power units, where they have given you option between the method that you want to select, SLM, straight line method, or the present method which we are talking about, which we call as block wise, and which is on WDV basis, because as you see, we are computing depreciation on WDV. Now, presently we are studying this. Why? Because clause 2 says that for depreciation of all other assessees, you have only one approach, which is block wise. But only if you are a power generating unit that is into electricity business, we will give you a choice of SLM. So this part is mainly theoretical. We'll study that later. We are dealing with right now this, which is applicable to everyone. Now in this, there is a special clause 2A, which talks about additional depreciation, but it is not for all. Now, let me just take you to a theory part on this additional depreciation. Now I'm here. This additional depreciation, first important point, will not be allowed if you are in the new regime. So now students, this is your third point of difference between the old scheme and the new scheme as far as PGBP is concerned. First is old scheme allows you deduction of scientific research where payment is made to outsider. New scheme does not allows. Second difference is 35 AD deduction. Old scheme allows, new scheme does not allow. And third, old scheme allows additional depreciation also. So besides regular, it also says claim one more depreciation. So claim two depreciations, the regular, additional. New scheme says, sorry, you can only claim normal depreciation. So additional depreciation is not allowed in the new scheme. Now, let us say the question is on old scheme. So now you can claim additional depreciation, but in this, the first point is very important. Now, in the previous class, out of the different questions we were solving, there was one question which had one adjustment relating to additional depreciation. Try to recall our previous class sums that we solved. And in that, they were saying solve it by the old scheme. So it was old scheme means additional depreciation is applicable. However, we did not take the additional depreciation in that question. Why? At that time itself, I have told you that additional depreciation is allowed only if you are a manufacturer. And if you recall, in that question, if I'm not wrong, it was question number 7, I think, as far as I remember, you were given as a trader. So if you are a trader or if you are into service sector like a bank or an insurance company or a transporter, you will not get additional depreciation even in the new scheme, even in the old scheme. New scheme anyways is not allowing additional. Old scheme allows additional depreciation, but it has conditions. The first condition, you should be a manufacturer. Second condition, the asset that you have purchased should be a new asset, not a second-hand asset. So if you are purchasing second-hand asset, I will not allow you addition. Third, out of all the assets, we will allow it only on plant and machinery. So anyways, building will not have it, furniture will not have it, motor car will not have it, only plant and machinery will get additional. That also only that plant and machinery which is used in production. Now you'll say, sir, what is a plant and machinery which is not used in production? So even the AC which you are using, AC is a machinery, but it is not used for production. It is used for office cooling. So there are certain equipments, or you can say machines, which we purchase in our business, but it has no connection with production, right? So those are not available. And last condition for additional depreciation is, I have written here except 100%, means what? If the rate of depreciation, the normal rate of depreciation of your plant and machinery is already 100%. It means you are claiming entire cost as depreciation in regular depreciation itself. Why will I allow you any additional depreciation? So additional depreciation will not be allowed if your normal rate of depreciation itself is 100. So these are the 5 conditions. One, you are a manufacturer. Asset is not a second-hand asset. Asset should be only plant and machinery, which is used for production and whose rate of depreciation, normal rate, is not 100. When all these conditions you satisfy, then under the old scheme, they say additional depreciation is allowed at the rate of 20% on the cost. Now, importantly, since it is saying it is allowed on cost, this point becomes important. Additional depreciation can be claimed only once. It is not allowed every year because once the year changes, the asset in the second year is as good as old asset now because you have already used it once. We allow it only on new asset, so it cannot be allowed in the next year. So it will be allowed only in the first year. Now, if in the first year, when you have purchased the asset, if the asset is put to use for less than 180 days, what we have studied, wherever asset is put to use in the year of purchase for less than 180 days, you take only 50%. So 50 of 120 means you will take only 10%. Now in such cases, where in the first year, the depreciation allowed to you was only half. Why half? Because it was put to use for less than 180 days. Then the balance half you can claim in the immediate next year. Why this point is written? Because condition is additional is allowed only in the first year. But if in the first year you could not take the entire 20% deduction, you had only taken 10% because of that 180 days rule, then the balance 10% can be taken in the next year. So half in the first year, half in the next year. But if you have got entire 20% in the first year itself, then second year onwards, there will be no additional depreciation. I hope this is clear to all students. This point is anyways, now you can say not relevant. This point is also not relevant to you, though I have typed here because it is still there in the law, but it is not applicable. Why? Because it was applicable up to 2021 or 21-22. So both these years are now long back. Now we are in 25-26 rather. If you go by AY, we are in 26-27. So this will no more be applicable. So you can leave it. So this is about additional. Now, there are two depreciations. One is the regular or normal depreciation. One is additional. Additional has only one rate, which is 20% of cost, and regular has different rates. Now in different, I'm just striking out land. We normally write land and building generally in accounts, but income tax and even accounts do not give you depreciation for land. It is only for building. Now see, within building, there are different rates. However, I've given you the most common rates. When you will require these rates? When in the question they have not given you the rate. If question has given you a specific rate, you'll go by that rate. Otherwise, you have to remember these rates so that you can use them in exams where the rates are not given. First, for building, 10%, furniture 10%, plant and machinery 15, motor car 15, computer and software 40, books 40, intangible assets 25. When you will read this from module, you will find multiple rates in plant and machinery, multiple rates in building, but that or those rates, each and every rate, you need not learn. So in the exam, if they want 40% plant and machinery, they will tell you this plant and machinery is 40%, then you claim depreciation 40. But if they have only said 50 plant and machinery and no rate is given, then you should know that generally majority of plant and machinery come under 50. So these are the rates which you should learn. These will be required when the question is not specifying the rates. If the question is specifying the rates, then you will apply those rates. Now, these are all rates for normal depreciation, right? Is this clear, students? Any questions or doubts up to this point? Sushmita is asking depreciation on remaining assets will be on WDV minus asset on half. Yes, so Sushmita, what you have said is right. Now, when I'll take a practical question, you'll understand this point. So in next 10 minutes, you'll understand, you'll get answer to your question, Sushmita. So is this clear, students? So now we are going to go to a practical question. Aditya beta, you are asking me what is half and full. I've been talking about that since past 10 minutes. Sridhar, don't worry, beta. Ship depreciation rate, they will give you in the question. Don't worry for that. See, these are some very unique assets. They are not assets normally in your books of accounts also. Correct, Sridhar? So they give you these rates. So there are different rates for ships also. I've purposefully not taken over here because you need not learn them. These are all special rates. If by chance the question have them, they will be given in the question, right? Okay, students. Now, let us take a practical question to understand all these pointers, provisions that I just explained. Anshika has asked a good question. Is there a depreciation is starting from which date? Date of purchase or put to use? Very important question, students. See, income tax is not going by the purchase date. Income tax says depreciation will be allowed only when the asset is put to use. So for the purpose of calculating depreciation, you should keep in mind that for us, the relevant date is date of put to use. That again, you'll understand from this question. Now in this question, we are dealing with different cases. So there is one question is the same asset is given, the data is also same, but in every case, I have changed one of the pointers, which makes it a different type of question. So I have taken one same asset, but these are independent cases. Out of these 4 5 cases, one of the case is what you will be getting in the exams. So A, B, C, D, E. I'll just correct this. This is E. Now, what is the data given? Opening, you have 3 machines. Value is 1000. You purchase 2 new machines. One is X, one is Y. Independent values are given. They may be purchased at different points of time. In fact, in the remarks, something is given. I'll come to that. Then during the year, 2 machines out of this opening, some old machines were there. You sold them. The combined value of both the machines is 650. Right? Now, this is the simple data given. Now, with this data, we will be solving depreciation as per the format and we'll be getting the answer. Now, in remarks, what is given? Both these machines X and Y are purchased on 15th May. In case of A means this case study, you have to assume that both machines are put to use on the same date. So for case study A, both machines are purchased and put to use both on 15th May. However, for remaining case studies, that is from B to E, the fact which I have changed is that they are purchased on 15th May, but machine Y is put to use on 15th October. So date of purchase is same. The only thing which I have changed, which will be applicable from case B onwards, is the date of put to use of machine Y. Fine, students? Clear, everyone? Now let me solve them. Okay. Computation of depreciation, section 32, read with rule 5. Two things parallelly we are doing, 32 and rule 5. Now what is the format? Format is particulars. And then here you will write the blocks which are given in the question. Right now I am writing case A because we have only one block given, that is plant and machinery 15%. But we are given this with different situations. Now what is the format? Format is same for all. We have opening WDV, which is as on the first day of the year. So it is April 2025. Then you have assets which are purchased. Then you have total. Then you have sale value of assets sold. And subtracting this, what you get is called as WDV under 43.6. And this is again calculated as on the last day. Right, students? Now here, I will get a total. 1 second. Total. Then after subtracting the sale value, I'll get WDV. Now here, I will be computing my depreciation under section 32. In this two depreciations, regular depreciation, half. I'll leave one line blank for showing the working. Full, again, I'll leave one line blank. Now, if you are in the old scheme, only then you will have this depreciation. If you're in the new scheme, your working is over with regular, there will be no additional. Now again, half, one line blank, full, one line blank. And this will give me my closing WDV. 31st March 26. And this closing will become my next year's opening. Right? Now, interestingly, students, I'll show you something else. Calculation of capital gains. Now, this will be our next chapter starting from the next class. But the calculation of capital gain is linked to the calculation of depreciation and above working. So I'll show it here itself so that this point we need not again study. Now, what is the format of capital gains working? It is sale value because capital gain is on sale of assets, which is called as FVC. Technically, what is FVC? That we'll see later on in capital gain chapter in the next class, minus expenses on transfer. That is any expenditure you incurred for selling the asset. You get net consideration. From that, you subtract cost of acquisition, which is called as COA. And if after acquisition you have incurred some capital expenses in future, it is cost of improvement. See, whether you understand these terms or not makes no difference today, because today we are not focusing on capital gain working, but it is simple. Sale value of asset minus cost of purchase and any future capital expenditure that you have incurred, and also subtracting expenses which you may have incurred for selling the asset, like registration fees, legal fees, advertisement done for sale, etc. Now, both these things will understand parallelly, right? Now we go to our case 1. You have opening 3 machines, value 1000 rupees, and you have purchased 2 different machines, total value is 800. So purchase 1000, 3 machine, not purchase, sorry, opening, and purchase is 200 plus 600. So total is 800, which is of 2 machines. Total is 1800, which is of 5 machines. Now, students, I hope you understand that in all these cases, this total is going to remain same because we are having the same case. Only I have changed something in the later part. So up to this, all the case studies are having same figures. Now comes the sale value. Now what is given for sale? I have sold 2 machines out of my opening assets, that is the old assets, and it has got sold for 650 rupees. So 2 machines sold for 650. Now, what is my balance? My balance is 1150 and the number of machines left are 3. I hope you have understood till this point. This balance is called as WDV under section 43 subsection 6. We have to find out this position as on the last day of your previous year. Now, once you reach this position, the first point that you have to check is, should I compute depreciation or should I compute capital gains? This decision has to be taken at the point when you find out the WDV under section 43.6. Pay attention, students. It means in every case, you will have one of the two. Either you will have depreciation or you will have capital gain or loss calculation. You will not have both the calculations in the same year for that block. Now, how to decide whether depreciation or whether capital gain? The answer is, if there is a WDV, and also if there are assets. So you have both the things. WDV is also there, assets are also there. Then you will calculate depreciation. Capital gain will not be applicable. So for first case, capital gain is not applicable because depreciation is applicable. And what we have understood from this, when depreciation is applicable, one, when you have some WDV balance in that block, and when you have some asset balance in that block. When capital gain will apply, when any one of this is zero. So either the WDV has become zero or number of assets have become zero. As on 31st March, if the position of your block is any one of this is zero, in that case, you will not be computing depreciation. You will be going to capital gain calculation. So the first thing that you check after reaching this stage is whether depreciation or whether capital gain computation. So here we have depreciation. Now coming to both the depreciations, now I am solving this sum under the assumption that we are doing it under the old scheme. If this is the new scheme, the only difference is you will not compute this. Simple. Only you will compute this, that will be done. If it is the new scheme. If it is the old scheme, you will compute both the depreciations. This is the only difference in the old and new as far as depreciation is concerned. Now coming to the calculation part. Please remember this depreciation, which I'm calling as regular, this depreciation is calculated on this WDV amount, that is this amount. So regular depreciation is calculated on the WDV amount, and additional depreciation, which is applicable only in case of old scheme, is to be calculated on this amount. What is this? This is the, I'll just change the heading. What have I added over here? I have added the cost of asset purchased during the year. Like how here I have subtracted the sale value of asset sold. Here I have added the cost of asset purchase. So you have to keep in mind that additional depreciation, since it is allowed only in the first year when the asset is new, it has to be calculated on the cost. Regular depreciation is allowed every year. It is to be calculated on this WDV. Done. Now, once you have decided and reached to the conclusion that yes, depreciation is to be calculated, then you will check whether regular and additional both are calculated. For this, you have to first check old scheme or new scheme. If it is new scheme, only regular is calculated. If it is old scheme, additional is applicable, but only when all the 5 conditions are satisfied. First, you are a manufacturer. It should be a new asset. It should be plant and machinery. It should not be an asset having the rate of depreciation as 100%, and it should be used for production. Now, since I'm solving by the assumption that it is the old scheme, so we have to check these conditions. So assessee is a manufacturer. Yes. Asset is plant and machinery. Yes. Nothing is mentioned about X and Y. So we are presuming these are new assets because normally you purchase new only. Very rarely you purchase second hand. So we are presuming it is new. Correct? And again, we are presuming it is for the purpose of manufacturing. So all conditions are satisfied. Hence, we are going to do calculation under the additional depreciation also. That is here, we will solve both additional as well as regular. Regular anyways, you are going to do in every case. Here, you are also going to do for additional. Correct? Now, when you have to do depreciation calculation, you have to check for half and full. So Aditya, now pay attention because you had asked me a query, what is half, what is full? So we had studied here in the provision that where the asset is purchased and in that year it is also put to use for less than 180 days. So for all the assets which are purchased and put to use in this year, if they are put to use for less than 180 days, you will claim half depreciation. Half means half of the rate applicable. And if the asset is put to use for more than 180 days in that year of purchase, you can take full depreciation. And for this, I have given you the cutoff dates also. So you have to check the date of put to use. If your put to use date is after this date, that is after 2nd October, you will take half depreciation. If your put to days is on 2nd October or before 2nd October, you will take full depreciation. Clear, students? Now, in my, first case study, what is given? Both machines are purchased on 15th May. Okay. And when they are put to use, in the first case, both machines are put to use on the same date, that is on 15th May itself. So this is also put to use on 15th May. This is also put to use on 15th May. And it is before our cutoff date of 2nd October. It means my first case study do not have additional depreciation. Sorry, do not have depreciation to be calculated at half the rate. So it means in this first case study, there is no half depreciation. Whatever depreciation I'm going to claim, that is full depreciation. Correct? Why not half? Because the asset put to use date is before 2nd October. Right? Now, how to compute full depreciation? Now remember this, regular is calculated on WDV. How much is WDV? WDV is 1150 multiplied by the rate. What is the rate of regular depreciation? It is the rate given for that asset, and the asset rate is 15%. So regular depreciation is calculated at this rate. So you calculate this, you'll get the amount of depreciation, which is only full in this case. Now we are in the old scheme, and I've checked all the 5 conditions. They are satisfied. Assessee is a manufacturer. Asset is plant and machinery. It is new, that is not second hand. It is used in production. This is assumed. And the rate is not 100%. We know the rate is 15%. So additional is applicable. Yes. On what amount this additional is calculated? It is calculated on this cost. So I'll calculate additional depreciation on this cost. What is the rate of additional depreciation? This is the rate. So I'll get the amount of additional depreciation. Students, I hope you have understood this working. So if you have understood this, then you can now get the amounts also. This amount will be how much? 115 and 57.5. This will be, and this will be 160. Correct? So this becomes your amount of regular depreciation. This becomes the amount of additional. You subtract it, you get closing WDV, and these figures will become the depreciation. The total of these figures will be the depreciation of the current year, that you can use it in your computation of final PGBP income. Fine, students. Simple. Your majority of depreciation calculation will be falling in situation A. Now we go to situation B. Okay, there is some typo error. This should be C. This should be D. Yes. Now we go to case B. Now case B, all figures are same as case A except this. Right? So opening has no problem. Purchases has no problem. So up to this, the figures are same. What has changed is only that these 2 machines which are sold for 800. Okay. So I will now subtract 800. How many machines sold? 2. So what is left is 1000 for how many machines? 3. I'll just put it in brackets so that you understand we are subtracting. Fine. So this one figure has changed in case B. Now pay attention. In remarks, what is given? In all other cases, Other means other than A. That is now from B onwards, this part is applicable. Now from B onwards, what has changed is that this asset Y is put to use on 15th October. So from B onwards, you will have half depre for machinery Y. Correct? Why will you take half depre for machinery Y? Because the put to use date is after 2nd October. So from case B onwards, the one common point that you have to keep in mind is this machinery Y will now get half depreciation. Now this point, once you understand, entire depreciation is over. Now pay attention. So now you have half depreciation also. Yes. Now half depreciation is allowed only on one asset. What is that asset? One asset, it is machinery Y. So the half depreciation that you have to claim is only on one asset. That one asset is right. Correct now? Now, how much is this depreciation? How will we get? Simply, I'll have to make calculation of this half depreciation and I will make calculation of the full depreciation. Now, half is only on machinery Y. What is the cost of machinery Y? Students, go back to the question. The cost of machinery Y is 600. So I've kept it same so that there is no confusion with the amount. So the cost of machinery Y, yes, very good, Sushmita Vishakha, is 600. Now, since machinery Y is put to use for less than 180 days, I will take half depreciation. Half means half of the rate. What is my rate of depreciation for this block? It is 15%. I can take half, means I can take 7.5%. This 600 is what? It is the value of Y machine. Right? Now comes full. It is all other machines. That is full. Now, importantly, students, pay attention. On what amount I will get full depreciation. So understand this. The total WDV of my block is 1000, right? Total WDV is 1000. I'm sure you understand this. Out of which 600, which is the value of Y, I have taken for half. So the balance value is 400 because total value is 1000, out of which 600 I have taken in half. So for full, the balance value is 400. I hope this is clear. Mehak beta, we are computing which depreciation, Mehak? We are computing the regular depreciation. As I've explained earlier, regular depreciation, Mehak, is calculated on which amount? It is calculated on WDV. When we will go to additional depreciation, we'll take the cost. So this difference I have mentioned earlier. Additional depreciation is on cost and regular depreciation is on WDV. So right now, when we are taking the calculations, here we are keeping this in mind that I have to take regular depreciation on this 1000. Now, what is the breakup of this 1000? I'll find out the cost of machinery Y, which is 600, and remaining balance of this block is now 400. So this is how you get the breakup of the values. So 600 is the cost of machinery Y. On that, you have taken half because that is put to use for less than 180 days. Balance 400, you will take full. Clear, students? Now we come to additional. Now additional, as you can see this arrow going up, where it is going up, it is coming to this cost. So additional is on cost. Total cost, we all know of both the machines combined is 800 in the question. Now we have to do breakup of this 800 in our additional depreciation work. Again, out of 800, 600 is of machinery Y and 200 is of machinery X. You can also check this from the question. See, 200, 600. So 600 is of Y, 200 is of machine X, again half. Now what is half? Additional depreciation rate is 20, so half is 10%. What is full? 20%. So just you have to understand how to do breakup of your value between half and full. So for regular depreciation, the breakup is of this, that is WDV. So here you can see breakup is of 1000, which is 600 and 400. And for additional, the breakup is of cost, which is 600 and 200. Once you understand this, students, the remaining thing is taken care of. Now you can simply use your calculators, find out the half and the full depreciation here, half and the full depreciation here. Is this clear, students? And then subtracting it, you can find out the closing WDV. Right, students? So this amount I'm getting as 40. This amount I'm getting as 60. Again, this amount I'm getting as 60. And this amount, 600 into 7.576 are 42 and half. So these are the students' amounts of depreciation. I hope it is understood and clear to everyone. Done, students? Clear? Very clear? No questions, no doubts? Please confirm, students. Good. Everybody clear with this? Good. Very good. Perfect. Okay. Let us go to our third scenario. In third scenario, again, opening and the total of purchase, this is 1800, no doubt. Now the situation is changed. Sale value I have changed to 1250. Again, in this, as per the remarks, the machine Y is put to use on 15th October, which is less than 180 days. Right? So up to this point, it is same. The difference is now the sale value has changed to 1250. Now, since this is 1250, what is the balance left? So my WDV is only 550. Right? Clear? Now pay attention. Again here, half, full. Now we have to take the breakup of this 550. Pay attention. Now this 550 I have to use in half and full. For half, we have to take the value or the cost of machinery Y. Now what is the cost of machinery Y? The cost of machinery Y is 600. But interestingly, I don't even have 600 as a balance. If I do not have 600 as a balance, I cannot take depreciation of 600. Now I have no choice but to take depreciation of 550 at the rate of 7.5, which is half. And since this 550 I have taken here, now for additional, there is no balance. Sorry, for full, there is no balance left because my entire WDV got used up for half. So now in this case, you would have understood what is the difference between case B and C. Now in C, what is the different point? The different point is that you are utilizing your entire WDV in the half section itself. So nothing is left for the full section. In fact, in half also, you should have claimed on 600, which is the cost of Y. But since now that 600 is not even my balance, I cannot claim or calculate depreciation of an amount which is above my WDV. So the maximum depreciation which I can get is only of 550 into 7.5. and there is nothing left for full. Clear, students? And then in additional, again recall, see this arrow, where this arrow is going, additional is to be computed on cost. So now you'll see the cost. Again, the cost of the two assets is 600, 200, so it is 800. So here I'll do bifurcation of 800, so it is 600 of Y, 200 of X on this half rate, on this full rate. So for additional, I do breakup of cost. Cost is 600 and 200. 600, which is for Y, is taken in the half category, and 200, which is of X, is taken in the full category because of the 180 days rule. Right? So this is 41.25 nil 60 40. These are my depreciations. Yes, Tanisha, correct. Yes, Sridhar, correct. Clear, students? So another possibility in the exam could be this, that the WDV is not sufficient even for half. So no question of full. This is a very rare possibility, but I've taken or I've given you the idea that if this happens, what will be your answer? Now, students, interestingly, in all these three scenarios, you have WDV plus asset, WDV plus asset, WDV plus asset. So in all the three scenarios, we computed depreciation and there is no capital gain working applicable because capital gain will not arise in first three scenarios because in first three scenarios you have depreciation. So one of the workings will apply either depreciation or the capital gain working. Right, students? Yes, now this will be a question. After you see this third scenario, Gautami has raised a very valid question. Sir, is it necessary to always first take the half depreciation and then the full? The answer is yes. The law has in section 32 read with rule 5 provided this specifically that when you are doing depreciation working, you have to first go for the half and the balance left after that any will be for full. So you're right, Gautami. You have to first take the half depreciation. Perfect. Now, the other two scenario students will be very easy for you all. Now, what has happened? Again, opening, purchase, this will be 1800. Now, sale is 1950. So, up to this, no problem. Now, this is 1950. So, the two machines which you have sold have got sold for a very high value because of which your WDV has become nil. Now will come the scenario where you cannot compute depreciation. Why? Simply, no value, no depreciation. When there is no value left, how can you compute depreciation? So now you will not have depreciation working. Why? Because one of the values is zero. WDV asset, there are two things. Until you have both the things, you calculate depreciation as we saw. But the moment any one of this is zero, there can be no depreciation, right? And by default, the closing also will be nil because if there is no WDV, the closing balance of this block has become nil. Now in this case, we have capital gain. So first situation where you get capital gain is where in the depreciation block working, your WDV became 0. Very good, Kambira. Very good, Sridhar. Now we go to capital gain working. What we have to take? Sale value. What is the sale value? The sale value is 1950. And remember one thing, we are doing this for entire block of plant and machinery 15%. We are not doing it for one or two assets. We are doing it for entire block. And that is why we came to the calculation only when the block ceased to exist. Why ceased to exist? Because the WDV has become nil. Correct? So what is the value? Sale value is 1950. Is there any expenses given which you have incurred for selling the asset? No. So my net consideration is 1950. What is cost of acquisition and cost of improvement? You will study under capital gain chapter. There is a section 50 bracket 1 bracket 2. All these things we'll study later in capital gain. What it says, 50 bracket 1 bracket 2 says the cost of acquisition, cost of improvement in case of block of asset is this. That is a total of opening plus purchase. So logically also, this was your total cost of the block. It got sold for 1950. So 150 is your short-term capital gain. Why short-term? Why long-term? That you'll understand in capital gain chapter. For the time being, you have to just keep in mind that the difference that you get on sale of a block is to be treated as short-term always, as per rule of capital gain. So this 150 is your short-term capital gain. I hope this is clear to you all students. So in this fourth scenario, what has happened? Since my WDV became 0, when it becomes 0, when your total cost of the block is lesser and the sale value that you get maybe by sale of 1, 2 or any number of assets exceeds the total cost of the block, the WDV of the block is 0. Obviously now there can be no depreciation. So you go to the capital gain calculation and there you are getting a gain, a profit of 150. Right, students? Clear? Scenario number D. Perfect with everyone? Good. Yes, everybody. Is it clear? Super. Very good. Okay. Now moving on to the last scenario. Again, opening, purchase, same. Now what they have changed the scenario is they are saying all machines are sold, not two. All machines are sold for 1450. So up to this point it is same because opening and purchase is same. But now you are selling all the machines. All 5 machines are sold and it has been sold for 1450. Right? Now students, please understand and appreciate that when I'm selling this for 1450, I still have some value left, whatever value it is. But importantly, my assets have become 0 because I've sold all the assets. Now, if you're selling all the assets, can you claim depreciation? Answer is no. No depreciation, no asset. Logical, na? If there is no asset left, on what will you claim depreciation? So again, depreciation applicable will be 0 and the closing value will be treated as nil of the block. I know there is some value here. I'm purposefully not writing it. Why? Because if all assets are sold, what is the sense of that value? Just visualize this. Can you put some value in the balance sheet against asset if there is no asset left? If all assets are sold, answer is no. You have to ignore that value. So logically, your closing value of the block will be nil. And now why nil? Why? Because all assets are sold. So even if there is some value left, that makes no sense. All assets are sold, no depreciation because you are having no assets. And now again, capital gain working. I've sold all the machines for 1450. My net consideration is 1450. What is my cost of the entire block? 1800. Now this was the difference, which is the balance there. But that balance cannot be called as the asset balance. Rather, it is your loss. Because what costed you 1800? All five machines you have sold for 1450. So 350 is logically your loss, which will be called a short-term capital loss. And that is how the closing WDV of the block will now be nil, because this 350, whatever was the balance, is now your short-term capital loss. You agree to this? You understand this? This is the entire depreciation. Besides these five scenarios, there can be no other scenario in depreciation. And interestingly, alongside depreciation, we have also done capital gain for block of assets. So in the next chapter, we will not be required to again deal with calculation of capital gain, at least as far as block of assets is concerned. The calculation of capital gain or loss is very simple. First, you have to check whether capital gain or loss has to be calculated. When it will be calculated? Only in two scenarios. What are those scenarios? Either WDV becomes nil or block is zero because all assets are sold, so assets become nil. In all other scenario where both things exist, there will be no capital gain calculation. You will continue with depreciation. So logically also you can keep in mind, either for a block you'll have depreciation calculation in a year, or for that block you can have capital gain calculation, not both in 1 year. And then the working of capital gain, which will happen only in two cases. One, WDV becomes nil or the number of assets become nil. The calculation is simple: sale value minus expenses minus cost, balance is short-term capital gain or loss. Simple. Understood, students? Very clear with everyone? Entire working of block. So we have done some part of capital gain here because it was linked. I thought you'll understand it better this way. So even though it is part of next chapter, we have done it here. Very clear to everyone, students? Entire working of depreciation, entire logic of block of assets, and the related capital gain loss. Great. Super. Chalo. So we'll take a 10 minutes break, our scheduled break, and then we will go to the remaining theoretical sections. If one or two sections are left, that we'll take up in the next class. Fine, students? Done? Clear? Yes. So if your asset is put to use before cutoff date, you take full depreciation, Mehak. If your asset is put to use after cutoff date, you take half depreciation. So that cutoff date of 2nd October, you should keep in mind. That will make your half and full decision simple in the exams. Understood? Chalo. Let us go for a break, students. On cutoff date is beta also full. I have already mentioned. Only after cutoff date is half. Up to cutoff date, that is cutoff date and before is full. Okay? Okay. So students, I hope the calculation part of depreciation is now very clear to everyone. Anybody still having queries, doubts? Good. Now we proceed, students, with the remaining theory part. Arun Sagar has some doubt. Yes, Arun.
Sir, actually, I have one doubt. Sir, yeah, okay. When are we going to claim additional depreciation? Even the new machinery sold, we can be claimed.
See, think logically, Arun. So your question is a very valid question, but think logically. If let us say, so you mean to say the new machine which I have purchased in this year, I have sold it in this year itself, right?
Yes, sir.
Now tell me, as on 31st March, because we are doing all this working only after the close of the year, and we see the position of our assets as on 31st March, right? As we saw in the format, we calculate WDV under 43.6 as on 31st March. As on 31st March, do you have the new asset?
Yes, sir. Sir, addition, okay, in the case last we solved the depreciation problem. We purchased some goods, new X and Y machine in middle of the year.
So my question is, as on the last day, do you have the new assets?
Yes, sir.
In which case you are talking? Last case, do you have it?
Sir, case 3.
Case 3 you are having. So what is the challenge? Now what is your, you said if the new asset is sold. That is your question.
Sir, sir, actually the balance is 550. So it is I purchased this year 800. It's indicating that already I sold 150 to
No, but it
150
does
worth
not
of.
indicate. See, 800 is one asset, 800 are two assets, X and Y.
Yes.
Have I sold anything out of those two assets here? Here, this two is what? The assets which I have sold is what? It is out of opening. It is clear cut given. See the question. What they have given? Two machines sold from opening. It is clearly given in the question. And
Okay,
that is
sir.
generally what will happen. Correct?
Okay.
Point number
Yes,
one.
sir.
But now still taking your scenario, let us say, for example, the new machine would have been sold. For some reason, let us say I purchase the machine and I do not find the machine as per my requirement. So I sell the machine. Possible?
Yes, sir.
Now coming to your question, if that new machine itself is sold, can you calculate or claim additional depreciation on the machine which is not there as on 31st March? Answer is no.
Okay, sir.
So if that new machine means, see, this is a very rarest of rare scenario. Till date, whatever 500 questions I have seen only on depreciation, I have not yet seen this particular type of adjustment, but still anything is possible. Answering your question straight and logic also I'm giving you, if that machine is not present with me as on 31st March, I will not compute any depreciation on that machine. So in that
Sir,
case,
both
you ask me whether
depreciation not
additional will
allowed.
be there. Answer is additional will not be there. Yes.
So means both depreciation not allowed. Okay, normal
On that
depreciation as
new
well as
machine, on that
additional.
machine which is sold.
Yes, sir.
See, regular depreciation anyways is calculated on WDV. In WDV, the value of different machines is included, right?
Yes, sir.
So you will get regular depreciation because regular depreciation is on the value. And the value
Yes, sir.
which we take for regular depreciation is after subtracting the sale value. So automatically the cost of that or the value of that new asset sold is gone out of your WDV, right?
Yes, sir.
So
Yes, sir.
regular will be there. While calculating additional, you will see whether X is there, Y is there. If X is there, you will take full. If Y is there, you will take half. Whichever machine X or Y is not there, you will not take that additional depreciation. Right?
Okay, sir. Yes, sir.
Clear now?
Yes, sir. Thank you, sir.
Perfect. Now, let us deal with some theoretical points after understanding the practical part. If you are a power unit that is engaged in generation of power, you are given option. One, you can follow this block method which we just studied, or you can follow the other method, SLM. Remember one thing, students, SLM is allowed only to power units. For other assessees, there is no option. There is only one method, WDV method, which we just studied, which is also called as the block method. Now for power units, when they are given option, the rule is this option can be exercised only once in their entire lifetime. Once is the first year when they start their business. Now in the first year, when they are going to file their returns, at that time, in the return, they will have to mark this option. And whatever option they have marked cannot be changed in their entire lifetime. So in the very first year of starting of power business, you will be given this option. Whatever you mark, later on it cannot be changed. Yes, Ketan. Ketan, I've unmuted you. Okay. Next, depreciation can be claimed both on tangible as well as intangible assets. Within tangible, you have building, plant, machinery, furniture. Plant is defined to include books, ships, vehicles, surgical equipment, etc. Next, asset may be used actively, passively. Actively means you yourself are using, passively means you have given it to someone else to use it. Both are eligible for depreciation. Next, if you are using the asset partly for business and partly for personal use, if you remember, we had studied this for other expenses also, the depreciation will be allowed in proportion to the usage in business. Half depreciation is calculated only if in the year of purchase, the asset is put to use for less than 180 days. Next, if you have taken the building on lease, it means you have not purchased or constructed yourself, you have taken it on lease. In that particular case, whatever capital expenditure you will incur on the extension of the building, that will be deemed to be your cost, or you are going to be deemed to be the owner of that structure. So let us say the building is of 4 floors, you have constructed 5th and 6th. Now the 4-floor buildings is on lease. So that is not your cost. But the 5th and 6th, which you have incurred out of your pocket, will be treated as your cost of acquisition. That is, you will be deemed to be owner. And last most important point, depreciation has to be taken compulsorily. You cannot decide whether to take depreciation or not. Once you have an asset, in that year, the depreciation working has to be done compulsorily, and whatever depreciation you get as per income tax calculation, you have to claim it, right? Then there are some special points with respect to depreciation calculation. What are these special points? Now we add cost in our WDV calculation. Now what is this cost? Try to recall accounts. It says it is purchase cost plus all expenses incurred till the asset is first put to use. Same thing we have studied in accounts, that all expenses till the asset is ready for use will be capitalized. Same thing over here. Arun is asking, sir, whether finance lease AS 19 applies. Arun, let me tell you one thing. Income tax do not follow accounting standards. It has created own standards, and whatever we are studying is as per their own standards. Now, these standards are called as ICDS, which you get to study in the final. But whatever provisions we are studying is in line with the ICDS, right? Now, there are some special cases of cost of acquisition. So what are some special cases? So I've categorized the different provisions into different categories for your easy understanding. So where you have derived some benefits for an asset or against an asset, then what will be the cost for you? It will be the actual cost minus the benefit derived. Now you'll say, sir, what type of benefit? Let us say the asset is used for scientific research. Your cost is nil. Why? Because you already got the benefit of total deduction, because scientific research allows capital expenditure. Same thing for 35 AD. What will be your actual cost? Nil. Why? Because you have taken entire deduction for 35 AD asset respectively. Now, if the asset is used by you outside India, or it has been previously used by you and then brought into business, you have already used the asset. So what is the benefit derived by you? The usage period. And what can be the quantum or the valuation of that usage period? Depreciation. So what you will take here as actual cost is the actual cost minus, for whatever period you have used that asset, you will deduct the depreciation, so the balance will be actual cost now. Correct. So students, these are some pointers about this. Like for example, another point given is subsidy or grant. If let us say your business is in some backward area, remote area, where some subsidy on some asset is allowed. Now in that particular case, what will be your actual cost? It is the purchase cost minus whatever subsidy grant the government has given to you. Is this clear, students? Second category of special cases is tax evasion. Wherever there is some tax evasion, the rule is that you cannot take the benefit of showing a fake cost to get benefit of tax evasion. So what will be the cost? It will be the cost determined by the officer, or in case where you are trying to show higher of the two costs, we will not take higher of the two costs, we'll take lower of the cost. So this is what is relating to tax evasion. And then this point, you will also study in capital gains. Now, what is this point? Where you have acquired the asset in one of the circumstances which is not treated as transfer, where not treated as transfer in the capital gain chapter. Like you have acquired the asset by way of gift or will, or where 100% holding company has given the asset to its subsidiary or subsidiary has given to holding. In all such cases, see, this is the whole list which we study in capital gain chapter as not treated as transfer. So these situations will not be treated as transfer for the purpose of capital gain. Now, in any of these situations, if you have acquired the asset, what will be treated as your actual cost? The answer is it will be the actual cost of the previous owner, that is the person who has given you the asset. If the previous owner has used and given you the asset, it will be the WDV of the previous owner, which will be treated as your cost. So these are three special scenarios relating to cost of acquisition. And last point in depreciation is, what if your revenue is less? That is, in a particular year, you have less sales, less revenue, and that is why you are not able to absorb entire depreciation. In other words, your depreciation becomes a loss. Why loss? Because you do not have sufficient income to recover the depreciation. In such cases, it is called as unabsorbed depreciation. And the rule for unabsorbed depreciation is that unabsorbed depreciation, so it is like a loss, can be set off from other heads. Yes, except salaries. So except salaries, from all other heads, you can adjust business losses. So if depreciation also becomes a loss, it can be adjusted from other heads income except salaries. You can also add one more thing, except salaries and winnings. Next, if this depreciation could not be set off or adjusted in the current year because there are no incomes, then it can be carried forward for any number of years. This point is similar to 35AD loss. Even for 35AD loss, same benefit was given, that it can be carried forward to any number of years. Yes, Arup, I mentioned that. Then there are other sections. Now, if you remember in the previous class, we studied all of these sections from our module. Let me take to what we have not studied. So we studied all these things. We saw the entire 36, 37, everything, if you recall. Now we go to some remaining sections. There is a section 43A, not much applicable at inter level. But what it deals with, if you have purchased a capital asset, taking a loan in foreign currency. So you have purchased the foreign asset. Obviously, it is also purchased from a foreign country. And while purchasing it, you have taken a foreign currency loan. In that particular case, any fluctuation in the foreign exchange rates will be adjusted in the cost of your asset. So if there is any increase and decrease over the period of the repayment of your foreign currency loan, if there is any increase or decrease in foreign currency rates, which is very obvious that it will happen, the difference, increase or decrease, will be adjusted in the cost of the asset. Now, We come to an important section, 40 clause B. This section is exclusively designed only for one person, that is partnership forms, and equivalently LLPs, because they are treated at par with partnership forms. Now, what does this section deals with? If you are a partnership firm, every year you recall your accounts, you'll find that every year the partnership firm pays three things to the partners. One is interest on their loan or capital accounts, then salary or remuneration because they are devoting their time, and last is share in profits. So these three things commonly in accounts also you have seen, right? Anil, but I have not gone into detail of that because that section 43A is not relevant for your exams, beta. So let us not spend time on that. I've just given you an overview. What you're asking, you'll get to study that in detail at final level. So let us not diverse from our syllabus. Anyways, we have a vast syllabus. Let us keep it limited to the topics applicable at Intel. Fine. So coming back, students, to 40 clause B. So as a partner, you are entitled to these three things. So from your side, this is your income. If you remember, we have already studied section 28, which says this will be treated as PGBP income in the hands of partner. This we have discussed. Now we are seeing it from the side of firm. In the hands of firm, it will claim deduction. Again, under PGBP head, under section 40 clause B. Or I will say as per section 40 clause B. Now what will be this deduction? So it says the deduction will be subject to fulfillment of conditions. First thing, this amount is exempt in the hands of partners. Why? Because in the hands of firm also, this is not their expense, rather this is the net profit of the firm on which firm has already paid tax. So firm is obviously not taking deduction of these profits, rather this is the profit which the firm is paying tax on as its own income. Now the remaining two things which are expense for the firm, for that 40 clause B has put some conditions. One for interest and one for salary remuneration, whatever you call it. These are allowed as deduction to the firm only if they are authorized in the partnership deed, which means partnership deed should specify that the firm will pay interest. It should specify the firm will pay salary or remuneration. If the partnership deed is not specifying this, firm will not get deduction. Second, when it comes to interest, income tax law allows deduction up to 12% per annum. Important. First, partnership deed has specified that you will pay interest. Second, you may specify any rate in the partnership deed, but the maximum deduction which we allow is 12% in income tax. Now what it means? Let us say partnership deed has said 10%. That firm will pay 10% interest. We will allow 10%. But if the partnership deed is saying 15%, you may pay 15%. That is your choice. Partnership Act allows it. We will allow as deduction only 12% because 12% is our maximum limit. So whatever interest you are paying to your partner, that rate or 12%, whichever is lower, is the rate at which we will be allowing you deduction. Is this clear? Now, the interest may be paid on the capital of the partner. Capital may be fixed or fluctuating. It may be on loan, it may be on advance, whatever it may be. But remember one thing, it should be authorized. So your partnership deed should specifically say it will be on loan, it will be on capital, it will be on fixed capital, circulating capital. Whatever your partnership deed has not said, we will not allow that deduction at all. So if your partnership deed says only interest on capital, and if you are paying interest on loan, entire interest on loan is disallowed. If your partnership deed is saying interest on only fixed capital, then interest on circulating or working capital is disallowed. So partnership deed should specify condition 1, condition 2. For interest, we will allow you up to maximum 12, which means either your partnership deed rate or 12%, whichever is lower. Now comes third. remuneration. Now, when we are talking about remuneration, there are two important conditions. One, only payable to working partners is allowed as deduction. Now, again, in partnership deed, it is your choice to allow it to all partners, working also and sleeping partners also. That is your choice. We have no problem. We will allow you deduction only to the extent it is paid to working partners. We will not allow you for non-working partners. And then the second point is maximum. Now, maximum limit up to which you can claim remuneration depends upon your book profit. What is book profit? It is your PGBP income. PGBP income means income calculated after all the above adjustments of reconciliation and before this remuneration. Why? Because the remuneration we are yet to calculate. So what is book profit? So book profit is your PGBP income before deducting the remuneration. Now on this book profit basis, you will find out how much maximum remuneration you can pay. So they have made slabs. If your book profit is up to rupees 6 lakhs. Now what is up to? It means either it is a loss or if there is a profit, the profit is up to 6 lakhs. So right from loss up to 6 lakhs of profit, you can pay maximum 3 lakhs or 90% of the book profit, whichever is higher. If your book profit exceeds 6 lakhs, let us say it is 9 lakhs, then for 6 lakhs, you will take 90% and for remaining, so in my example, the remaining is 3 lakhs. On 3 lakhs, you will take 60%. So this is how you will compute your book profit based remuneration. And this amount, whatever you'll get on first 6 lakhs, 90%, on remaining book profit 60%, total this amount, this total is the maximum remuneration of which the firm can claim deduction. So check how much remuneration you have paid to working partners. Let us say out of 5, 3 are working partners, make a total of remuneration paid to them. Compare it with this maximum amount that you have got by this calculation. Whichever is lower is your deduction. I hope this is clear. Now, clause BA, it deals with AOP BOI. Now, AOP BOI are treated differently from partnership firm. And most important point, any interest, any remuneration paid by AOP BOI to their members is completely disallowed. So for AOP BOI, there is no limits because entire interest, entire remuneration paid to their members, their partners is fully disallowed. 41 we have already discussed in starting. It is one of your credit side provisions where we have seen that what is covered in PGBP credit side is any amount which was earlier allowed as deduction. Now why? Because it was an expense or loss. If in the current year it is refunded, recovered, reimbursed to you, it will be treated as your PGBP income in the year in which it is recovered, reimbursed, or returned back to you. Now, students, we come to another important theory point. We will cover this and this today. And then one more theory point is left, which we'll be covering in the next class. Now, what is this theory point? Maintenance of books. Now, we have seen the entire PGBP chapter. We saw there are so many calculations, there are so many allowed, disallowed things that you have to deal with. Now, when is that possible? Only when you maintain proper books of accounts, because only from books of accounts, you will get to know how you have paid the amount, what is the nature of the expense, and then on that basis, you can decide whether it is allowed or disallowed. Now, for this, books are to be maintained. Now, interestingly, the question comes is maintenance of books under income tax law compulsory? Compulsory to everyone? Two, if it is compulsory, then what books are made compulsory? Now, for this, you have to understand that maintenance of books is not compulsory to everyone. For the purpose of maintenance of books, they have divided the assessee into two types of persons. One, those who are engaged in specified professions. Who are covered in specified professions? Doctors, lawyers, CA, CMA, CS. So some specified names are given. If you are into one of these professions, you are called as a specified person. Second category is covering the remaining persons. So professions which are not specified above, they are covered here, and all businesses are covered. Because here no business is covered, only professions are covered, and here all businesses and remaining professions are covered. Now, once you have understood this differentiation, so let us speak from the point of view of doctors and chartered accountants. When are we required to maintain books? If in all the past 3 years, all 3 years past, your turnover exceeds the specified limit given, you have to maintain specified books. Now, what are specified books? It is cash book. Cash book means obviously including the bank column. It is a ledger. 2 books are made compulsory, plus you need to have copies of bills, invoices, so documentary proof. These are the specified books. Now, these books have to be maintained only if you are into any of these specified professions, so it is applicable to us. But when these books are to be maintained compulsory, where in all the past 3 years, my turnover exceeds the limit. What if my turnover do not exceed the limit in all the 3 years? So it has exceeded, but in only 1 or 2 years, not in all the years. In that case, I have to maintain such books as would, now this point has got shifted here, I have to maintain such books as would help the assessing officer to compute my income. It means no books are prescribed. In other words, if you remember in accounts, we have something called as single entry. So you can maintain single entry books because they are sufficient to help the assessing officer compute your income, but they have not specified exactly what books. So I've used the word incomplete record. This is what is the name given for your single entry chapter. Correct? Now, if you are into any other profession other than above, or if you are into any business, then you are covered in the second category. Now for this, what is the condition given? If your turnover in all the 3 years is below the prescribed limit, you don't have to maintain any books. It means you are a very small business because your turnover has not exceeded in any of the past 3 years. But if it has exceeded in any of the past 3 years, then again, what rule is applicable? You have to maintain single entry books at least. So for turnover exceeding at least in 1 or 2 years, you have to maintain single entry books. But if it has not exceeded in all the 3 years, you need not maintain books. Next point about books is books have to be maintained at the principal place of business, and it should be maintained for minimum 6 years from the end of assessment year. So total 7 years is the minimum period for which the books have to be maintained. Correct, students? So this is about maintenance of books. Now there are two more provisions, tax audit and some special provisions for computing of income. This we will deal with in the next class, but I hope up to this point you have understood everything. So I'm sure that by now you will be in a position to do entire computation by yourself thoroughly. Yes, students, kindly do that. Anshul is asking, sir, what is AOPBY? See, Anshul, when you are working as a group, let us say 4 or 5 people have come together and working together as a team, but they have not entered into a partnership. They will be called as association of persons. Example I'll give you. The best example of this, if I have to connect it with your accounting topic, it is joint venture. So when 2 or 3 persons together take up some assignment, let us say there is some big construction project you have taken it together, but between you, you have not entered into any formal partnership, or you all together have not made a separate company, then you are called as AOPBY. Arun is asking, doctor case, they need to maintain extra 2 books. Yes, beta, obviously. So when you read the list of specified books for doctors, they have given you one is stock register and one is the daily case register. That is about the patient. You have to keep the details, obviously. Here I am just giving you a brief overview of what is given in the provision. So for doctors, you are correct. 2 more books have been prescribed, right? So students, from my side, this is the end of PGBP. Yes, 2 theoretical provisions are left that we'll deal with in our future sessions. I'll cover it in one of the lectures. So I hope now entire PGBP with all the computational provisions, all the technical provisions is clear to you. Again, I will request, it is completed from my side. From your side, it has started, which means you have to first revise the sections so that you don't forget it. Students, see, this is the biggest problem. You are studying something in the flow with the class. At that time, you are understanding everything. But after 1 month, 2 months, again, you feel, no, I don't remember anything. Sorry, I don't understand anything. It is not about understanding, it is about remembering. So I again request everyone, please make it a point that regularly every week on one dedicated day, you will revise all your past topics, not only PGBP. PGBP is more specifically I'm pressing because there are many provisions, different pointers, but this rule applies to all the chapters. So that by the time the class is over and now you start for your self studies, it should not happen that you don't understand anything, because it is not about understanding, it is about recalling. Fine, students, this is okay. Everybody, everything clear? Can we close today's session? Anybody, any doubts? No doubts? Everything clear? Perfectly? Good. But this material is already uploaded. Only the practical which I've solved today, I'll upload that sheet, Anil. Otherwise, the first sheet from which I'm teaching, my sheet is already uploaded on day 1. Perfect. Thank you, students. Thank you very much. Take care. Good day. Yes, sir. Thank you very much, Ashok ji.